Hey there, welcome to the ultimate guide on candlestick patterns, your ticket to understanding and mastering the art of trading. Today we're diving into 5 candlestick patterns every beginner trader should know, and I promise by the end of this session you'll not only recognize these patterns, but understand how they can help you make informed trading decisions. So, let's get started with a bit of history. Candlestick charts have been around for quite some time, and their origins are as fascinating as their practical use. These charts were first developed in Japan over 300 years ago by a rice trader named Munehisa Homma. He used them to track the price of rice and discovered that prices didn't just move randomly, they had patterns that could be predicted. Fast forward to today, and these same patterns are used globally to trade everything from stocks to cryptocurrencies. Now, imagine it's the late 1600s. Homma's rice trading techniques were so advanced that he reportedly turned an initial investment of $1,000 into $10,000 in a short period. His insights into price movements, captured in candlestick patterns, were revolutionary. Fast forward to the 20th century, and traders like Livermore, a name you might have heard if you've delved into trading history, used similar principles to make millions in the stock market. Livermore's success wasn't solely due to luck. His ability to read price patterns and trends played a huge role. Okay, enough about the past. Let's get to the good stuff. Those 5 candlestick patterns you need to know. First up, let's talk about the hammer and its cousin, the shooting star. Think of the hammer as a little hero that appears after a downtrend. Imagine a market that's been dropping like a rock, and then, bam, the price forms a hammer. This pattern has a small body at the top with a long lower wick, like a hammer being driven into the ground. The hammer tells us that even though the market dropped significantly, buyers swooped in and pushed the price back up by the end of the session. It's a sign that a reversal might be on the horizon. Picture it like this. It's as if the market is saying, "Hold on, I'm not done yet." On the flip side, the shooting star is the hammer's bearish counterpart. It looks similar but in reverse. It has a small body at the bottom with a long upper wick. Imagine a rocket shooting up, only to be dragged back down by gravity. The shooting star suggests that buyers tried to push the price higher, but sellers stepped in and brought it back down. It's often a signal that the uptrend might be coming to an end. Next, let's dive into the engulfing pattern, a favorite among traders for its clear reversal signals. Picture this. The market's been moving in one direction, and suddenly a candlestick appears that completely engulfs the previous one. If you've got a bullish engulfing pattern, it looks like a large green candlestick that completely covers a smaller red one. It's like a big, confident wave swallowing a smaller ripple. This pattern tells us that buyers have taken control from the sellers. Imagine a tug of war where one side suddenly pulls with all its might, overwhelming the other side. That's what the engulfing pattern represents, a potential shift in momentum. Conversely, a bearish engulfing pattern happens when a large red candlestick engulfs a smaller green one. It's like the sellers have taken charge and are ready to pull the market down, signaling a potential trend reversal. The Doji, a pattern of indecision. Picture this as a moment of pause in the market's hustle and bustle. A doji looks like a plus sign or a cross, where the opening and closing prices are nearly the same. It's like a referee blowing the whistle and saying, "Hold on, let's see where this is going." The doji indicates that neither buyers nor sellers could dominate during the session. It's a signal that a change might be coming, but it's not quite clear which direction. Think of it as the market taking a breath before making its next move. Now let's explore the morning star and evening star patterns, 2 powerful signals for reversals. The morning star is like the sunrise after a long night. It consists of 3 candles, a long red one, a small-bodied candlestick, often a doji, and a long green one. Picture this: after a downtrend, the long red candle, the market pauses, the small-bodied candle, and then a strong green candle appears, signaling that buyers are back in control. The evening star, on the other hand, is the opposite. It's like the sunset before the market's night. It also has 3 candles, a long green one, a small-bodied candle, and a long red one. After an uptrend, the long green candle, the market pauses, the small-bodied candle, and then a strong red candle appears, suggesting that sellers are taking over. Lastly, let's talk about tweezer tops and tweezer bottoms. These patterns are like the final signals before a trend reverses. A tweezer top occurs at the top of an uptrend and consists of 2 candlesticks with similar highs. Imagine 2 birds perched on the same branch, both showing that the price couldn't move higher, signaling a potential reversal. A tweezer bottom, conversely, happens at the bottom of a downtrend and consists of 2 candlesticks with similar lows. It's like 2 dogs sniffing the same spot, indicating that the price couldn't drop any lower, suggesting a possible reversal. All right, now that we've covered the patterns, let's dive into how to read and interpret these candlestick patterns effectively. 1. Context is key. Just like a single line in a novel doesn't give the whole story, a single candlestick pattern doesn't provide a complete picture. Always look at the pattern in the context of the larger trend. A hammer might be a strong signal after a downtrend, but in an uptrend, it might just be a temporary pause. 2. Confirm with other indicators. Use other tools and indicators to confirm the signals given by candlestick patterns. For example, combine candlestick patterns with moving averages, trend lines, or volume indicators to increase the reliability of your predictions. Look for confirmation candles. After spotting a pattern, wait for a confirmation candle to appear. For instance, if you see a bullish engulfing pattern, wait for the next candle to confirm that the buying pressure continues. This additional confirmation helps avoid false signals. Understand the market sentiment. Candlestick patterns reflect the sentiment of traders. For example, a doji indicates indecision, showing that neither buyers nor sellers have taken control. Recognizing the sentiment behind the pattern can help you gauge the market's likely next move. 5. Practice and patience. Like any skill, mastering candlestick patterns takes practice. Use demo accounts to practice identifying and interpreting patterns without financial risk. Over time, you'll develop an intuition for how these patterns play out in real trading scenarios. So, what's the takeaway? Candlestick patterns are like clues in a detective story. They give us hints about what's happening in the market and help us make educated guesses about future movements. Just like how Homma and Livermore used these patterns to their advantage, you can use them too. Remember, candlestick patterns are powerful tools, but they work best when combined with other factors like market trends and support and resistance levels. They're like the ingredients in a recipe. Each one contributes to the final dish, but it's the combination that makes it truly delicious. As you practice and get comfortable with these patterns, you'll start to see them pop up in your charts, and you'll be able to make more informed trading decisions. So keep an eye out, stay curious, and happy trading. That's it for today's lecture. I hope you found this session insightful and engaging. Feel free to revisit these patterns as you continue your trading journey. And remember, every trader starts somewhere, and practice makes perfect.